Welcome, everyone. I want to thank you for joining us today. I'm Ina Kupferberg, and I am happy to welcome you to the last of our very informative series of financial literacy workshops being presented by UJA-Federation and Commonpoint Queens. It's nice to be here with all of you. While we can't physically be together or even see each other right now on Zoom, I know I speak for all of UJA Long Island Women, chaired by Pam Barnett, and Commonpoint's leadership when I say how grateful we are for the chance to gather virtually to be able to connect over timely topics and be in community together. Before we introduce our featured speaker, I want to share a few words about UJA's work in these challenging times and acknowledge the moment that we're in. It's been almost 12 months of living with uncertainty, and while we're so grateful for vaccines and the medical breakthrough they represent, there's still a long road ahead. More people are dealing with food insecurity. More are unemployed. More are worried about how they're going to make ends meet. And we need to be there for all of them, as we have been from day one of the pandemic. UJA has allocated $67 million to date in grants and loans over and above our normal allocations to support COVID emergency relief. One of the most vulnerable populations during this time are our Holocaust survivors. Did you know there are 36,000 Holocaust survivors in the greater New York area, and that 40% of them live at or below the poverty line? UJA on Long Island has an amazing and meaningful initiative called Witness Project that we started several years ago that focuses on high school students and Holocaust survivors spending time together and getting to know one another over the course of a school year. The students learn the survivors' stories and ultimately act them out or put together a visual arts project. The commitment of the students and the Holocaust survivors who have made this program a priority, especially this year, when there is so much trauma and stress in all their lives, has been incredible. All of the money raised through Witness Project, which goes to UJA's Community Initiative for Holocaust Survivors, flows directly to the survivors. Not only will you be supporting the social services that UJA and our partners provide for Holocaust survivors, but their emergency needs during COVID, like food and meal delivery, emergency cash for rent, medicine, and virtual programming. We all wish that we could fast forward to the ends of this crisis, to a fully recovered economy, to all of us gathering in one room together. We're not there yet, but UJA has the unique ability to meet unprecedented challenges. Thank you to all of those who have stood with UJA to make all this possible. Now I'd like to turn it over to Leslie Kraut from Commonpoint Queens.
Thanks, Ina. Good afternoon. I'm Leslie Kraut, a social worker here at Commonpoint Queens and director of our single parent program. Commonpoint Queens is a beneficiary of UJA funding. We are a community center serving the individual, family, and community needs of the greater Queens, New York area. We strive to sustain and improve the quality of life for all our community members during the pandemic and beyond. We are pleased of our three-part series on women and personal finance. Our speaker is Aviva Pinto, Managing Director of Wealthspire Advisors. Today's topic is financial planning and investing for beginners. If you have any questions for Aviva, please type them into the Q&A section. There will be time at the end for Aviva to answer any questions, and if there are any questions still remaining after, we will make sure that you receive the answers. This program is being recorded, and we also will have available the PowerPoint slides. You will have availability to receive all the recordings and the PowerPoint slides afterwards. Now I'd like to turn this over to Aviva.
Thank you so much. I am going to share my screen for everybody. And there we go. And want to welcome everybody back. And Definitely, we have covered quite a lot. So just to recap, we started off with savings and credit and the use of ATMs and looking at the credit unions and banks. We then went into longer term purchases like cars and homes. And we spoke about taxes. And so now what we're going to do is we're going to talk about financial planning, and then we're going to touch on investing for beginners. So what I want to do is, again, non-legal disclaimers. We're not born financial geniuses. We're not taught financial literacy in school. We don't know it from our families. So like I said, the first 2 sessions, there is no judgment. Some things you're going to know, other things are going to be new to you, and we are going to all learn something together. So let's start with what is a financial plan. So a financial plan is really just a roadmap. It tells you where you are and it tells you where you're going from a financial standpoint. And a lot of people say to me, well, you know, financial plans are only for very rich people. And that is not true. Everybody needs to have a financial plan. There are some facts out there. 3 out of 10 Americans have no financial plan, and 1/3 of those that have no financial plan have no retirement savings. So having a financial plan is basically going to show you how you are going to move forward financially with your life. So we talked about budgeting in the first session. And as a quick reminder, a budget tells you how much you're bringing in, how much you're spending, and what, if anything, is left over to save or invest. And we're going to be talking about investing today. So we talked about how you compile your budget, and your financial goals are basically what you're going to be saving for. Are you saving for a house, for retirement, for a vacation, college for your kids? The financial plan will show you how to reach any of those goals that you have created. So a financial plan is going to answer not only how you can reach that goal, it'll tell you when and if it's attainable. So it can answer questions such as, can I travel? Can I buy a home? Can I do home improvements? Can I pay for college for my kids? Can I provide care for my parents if they need it? Plan for a wedding? When will I be able to retire? And how much I'm going to need in retirement? We also talked about having cash on the side for emergencies, like your roof caves in, or you get into a car crash and you need to pay for a new car. And more importantly, it talks about what happens if you live longer than you expect. Will you run out of money? And it also tells you if you're taking on too much risk in your investments. And we're going to talk about that as well. So what kind of information do you need to put into a financial plan? So the financial plan is going to look at some of the things that we had in the budget, your income. It's also going to look at, do you have dependents? Now that takes into effect things like, you know, do you have to plan for their college, or do you have to plan for giving them a roof over their heads? It looks at what state you're living in, because different states have different taxes, how much you're earning, how long will your plan last? Now, women are living to be about 93 or 94 years old. So if you are 50 years old today, or you're 40 years old today, you're going to have 40, 50 years ahead of you that you need to plan for. The plan will look at, will you be getting Social Security, and how much will that be? It looks at how many assets you have. Do you have a house? Do you have a car? Do you have art, jewelry, insurance policies, those types of things? And it can look at whether you're going to use any of those things in your plan for the future. So do you need to sell your home and downsize after you retire? You know, are you going to have to sell your jewelry to make ends meet, or can you wear it and then pass it to the next generation? And then it looks at the debt that you have. And we spoke about debt in the last session, credit card debt, mortgage debt, any of those kinds of things, college. And most importantly, it lays out what are your needs, what are your wants, and what are your wishes. And we're going to go through each of those. So these are examples of needs, wants, and wishes. Needs are the basic items we spoke about in the last session that we put in with the budget. So your rent or the mortgage that you're paying, food, clothing, transportation, utilities, and your health care. Those are things that you need and you have to pay for no matter what. Wants are things like you want to own a home but are currently renting right now. You want to help pay for your kids' college, but they could take out loans. You want to buy a new car, but that old clunker that you're driving is just fine for right now. And then there's wishes, and wishes are, well, I've got my own home and I'm putting my kids through college, but I really want a vacation home. So we classify things into needs, wants, and wishes, and those go into your financial plan. So a financial plan can tell you how much money you will need to meet your needs, wants, and wishes, and it will classify those. So the needs are the things you absolutely have to have, and that is going to take the money that's coming in, subtract out all the debt that you have and the money that you need for the day-to-day, and then show you if there's anything left over to satisfy the wants and the wishes. It'll tell you how much you need to save and invest to get to the amount of money that you need. And we're going to be talking about investments next. And it'll show you trade-offs. So for example, if I save more and I spend less, how much longer can my money last? Or if I can buy a house, but maybe I can only be able to buy a smaller one. And the most important thing about a financial plan is it's not just done once and set in stone and put on the bookshelf and stays there. The plan needs to be changed and updated when your circumstances change. So for example, if you get married, if you get divorced, if you have another child, if you retire, all of those things, life events, will make you have to go back and change your financial plan because your goals have changed and your needs and wants have changed. So the financial plan will help you set both short-term and long-term goals. It'll help you stay on track to meet those goals and show you the big picture. So we've created a budget, we've defined our goals, and we've created our financial plan. So now we're going to talk about investing to meet those goals. So what is investing? Investing is putting money into something, expecting it to provide a greater amount in the future, which is also called a return. So we spoke about savings and compound interest in savings banks, credit unions in the first session. And in that example, we put $100 into the credit union and we received 0.5% interest from that credit union. So the credit union gave us a return on our money. So we actually invested our money into the credit union to get that 0.5%. So why do we invest? As I mentioned, women are living much longer. This shows you the life expectancy at birth in the United States. So if you were born in 1970, you would have expected to live to about 71 years old. Well, now, as you can see, this goes up to 2015, but in 2015, the average age was 78 and a half, 79 years old. So the future is getting longer every single day. And that is because of medicine and healthier habits. And, we're not working the kinds of jobs that our predecessors worked where, we were doing physical labor all the time. So longevity, so future is getting longer. We are living longer. Not coronavirus accepted. We are basically living longer. And so therefore we have to make our money live longer for us. So if we are retiring at the age of 65, we're still going to need, 25 to 35 years to make our money work for us. So that's one of the reasons why we invest. And we talked about compounding, and now I'm going to show you other ways that makes sense. So this graph shows you when you invest sooner. So if you invest at the age of 20, and this is assuming that, oops, sorry, went back. This is assuming that you're getting a 5% return. If you invest at the age of 20 and you take it all the way up until the age of 65, you're going to have close to $450,000 just investing $50,000 now at the age of 20. So it shows you how much you can earn by investing when you're young. If you start when you're 40 years old, which is the light blue line at the bottom, your money is only going to make $169,000, that same $50,000, assuming a 5% return. And that goes back to what I showed you the first time about compounding interest. The longer you have your money in, it grows longer over time. So let's talk about the types of investments. We said that you could put your money into a credit union or a bank, and you can get your return from that. And there's other places where you can put your money and make your money grow even larger. So besides the cash that we had that we put into the bank, there are things called stocks, there are things called bonds, and there are things called alternatives. And we're going to go through each one of those. So savings accounts or money market funds, that's what we put into the bank or the credit union in our first examples in the first session. It's got very low return, but it also has very low risk. And as I said, you can pull your money out whenever you want. So we call that liquid, which means that you can get it out right away whenever you want, same day, go to an ATM, take it out, Saturdays, Sundays, whenever it's there and it's available. So it's very low risk because you can't lose your money. It's insured. The credit union has credit union insurance, and banks have federal deposit insurance. So it's very low risk, but it's also only paying you right now 0.5%. There's other investments that are called stocks. And what a stock is just a share of a company that's issued by the company for an investor to buy. Stocks are also referred to as equities. So the stock market is what you hear about on TV, and stocks go up and stocks go down, but in the long run, they tend to rise. Now, if you buy, for example, we were looking at the car example last time when we were looking to purchase a car, and we were going to buy a Ford. So the Ford company will issue stock, and basically investors give the money to the company in exchange for a share of that company. And if Ford sells a lot of cars and is doing really well in the economy, then that share of stock is going to go up in the market. If people are not buying Ford cars and everybody is running to, say, buy Toyotas, or people just aren't buying cars in general, that stock will be worth less, because a lot of people will be jumping to a different kind of stock in the market because they don't think Ford or stocks or car stocks in general are going to do very well. And we're going to talk a little bit more about how you can get around that if you have purchased a share of stock in Ford. Another kind of investment is called a bond, and a bond is a form of lending money. So it's a promise to pay back the amount borrowed plus interest at maturity. It's also called fixed income. Now, it's very similar to what you're doing when you put your money into a bank and they give you interest back. But with a bond, the interest is a specific set amount. It's fixed. So if you buy a bond that has a 3% interest on it, it is going to pay you 3% for the entire life of that bond. So if you buy a bond that has a life of 5 years, and they call it maturity, so for those 5 years, if it's going to pay you 3%, you're going to get 3% every single year as long as you hold the bond for those full 5 years. Now, in between, there could be fluctuations in the price of that bond, but because you're holding on to it, it doesn't matter. You're holding it on to the end. You are going to be paid back the amount borrowed plus that 3% interest every year for 5 years. So bonds offer a unique value, and most of it is that they will not lose money. Now, this chart shows you, going back to 1996, all of the positive returns from the bond index by year. And as you can see, there were only 3 negative years the entire time. Now, bonds will have negative years if you're not holding them to their maturity. So in the last example, we had 5 years. If after 3 years you decided you wanted to sell back your bond into the marketplace, depending on where interest rates were, you could possibly have lost money. And I'm going to show you what happens with bonds. But there is an inverse or opposite relationship between the price of the bond and the interest rate that you get. So if interest rates go up, the price of your bond is going to go down. And if interest rates go down, the price of your bond is going to go up. So in the years where you see these negative returns, that is because the price of the bonds dropped because interest rates went up. But as I said, if you hold the bonds to their full maturity, you are not going to lose the money that you put in. But even if you do trade, you can see that through this graph, there have been very few years that bonds lost any money. So basically what I'm saying here is that if you want sleep at night money, money that you know is not going to lose value, bonds are a good place to put them. Now, all the other stuff that is not a stock and not a bond is considered alternatives. And alternatives can be things like real estate. It can be commodities like corn or oil. It could be art. It could be antiques, those types of things. And these are things that will have very, very low correlation to the US equity markets and interest rates, meaning that when interest rates go up and down or the stock market goes up and down, these things do not really move in response to those. So let's talk about what investing is and what it is not. So what it is it's long-term. You own what you're buying into, and it's really a buy and hold strategy. Warren Buffett, who is one of the best investor billionaires of our century, says that successful investing takes time, patience, and discipline. What investing is not, it's not short term, it's not gambling, and it's not trying to time the market. So if you saw the news recently about GameStop, where people were trying to make a lot of money and jump in and out of the market, that is for people who are short-term traders. They're basically gambling, and they're trying to figure out when to get in and out of the market. And that is not what investing is. Investing is long-term buy and hold. And why would we avoid market timing? Well, this chart shows you that if you were in the Standard & Poor's 500, which is basically the 500 largest stocks in the United States, and they have an index that shows what happens on a day-to-day basis. So if you listen to the news and they say the market went up, they're either talking about the Dow Jones Industrial Average, which has 30 industrial stocks, or they're talking about the Standard & Poor's 500 market, which has 500 of the largest stocks in the United States. So if you had been fully invested, you put $100 that we had put in the credit union in our first session example, if you had put your $100 in between January 1990 and September 2020 and stayed there and not done anything, you would have gotten a 9.9% return on your money. Now, there would have been fluctuations day to day, week to week, month to month, because the market doesn't go up in a straight line. But if you had stayed and not done anything, you would have gotten a 9.9% return. Now, that is a lot better than the 0.5% return than we had in the savings bank. But if you eliminate, sorry, let me get rid of this, the 10 worst days in the market, your return would have jumped to 13%. If you eliminated the 25 worst days, it would have jumped to 16%. And if you eliminated the 50 worst days, you could have gotten a 20% return. So why don't we just eliminate those days? Well, the problem is that we can't time the market. Nobody knows when we're going to have the best days and when we're going to have the worst days. So if you eliminate the 10 best days of the market, your return would have been 7.15%. And if you eliminate the 25 best days, it would have dropped to 4.54. If you had not been in it for the 50 best days, your return would have only been 1.25%. So 8 of the worst 10 days happened within 2 weeks of the 10 best days, which is basically saying that unless you knew exactly when to jump in and when to jump out, you would have been worse off than just staying fully invested during that time. So that's one of the reasons why investors avoid market timing. And the people who are trading all the time, they don't always make a better return, because if they miss these great days, their return is going to be a lot less than if they had stayed invested. So now we know a little bit about stocks and bonds and what is out there other than money market accounts and checking and savings accounts. Let's talk about how we build a portfolio. Now, I like to tell my clients that we have to have our buckets. What are we going to do in the short term? The short term is 0 to 3 years. And typically those are for the things, when we talked about our financial plan, of the needs. These are the things that we're going to need: our rainy day fund, our current expenses, our big purchases that we know that we have to have. Our refrigerator died, we have to buy a new one. And we're using it to pay down our credit cards. The potential investments for that time horizon in the short term are liquid, lower risk, and we're trying to preserve our capital. So those would be the savings account type funds. If we have an intermediate term, so these are more for our wants, a big purchase, our home improvement, planning for an event, paying down, some mid-sized debts, like, we pay down our mortgage a little bit, or we pay down our car bills. Those are intermediate term goals. And there you would want a balance of both stocks and bonds and alternatives. So you would have a little bit in stocks, a little bit in bonds, a little bit in, say, real estate. And then we have our goals for long-term. And long-term is really 10 years or more. And those are things like planning for a retirement, or deciding to gift to your university, or planning on gifts to kids or grandkids. And those things, you can have a more aggressive allocation. You can have higher risk, and they can be more speculative because you've got a much longer time horizon and you don't really need that money right away. So you don't have to really worry about the fluctuations. So the most important rule of investing is that there is an inverse or opposite relationship between risk and return. The more risk you take, you're going to have a greater return. So if you go into things that are extremely risky, you are going to want to have a much higher return on that money. So this graph shows you on a risk return graph where risk is on the bottom and return is going up the side, where things fall of some of the things that we were talking about. So treasury bills and money market funds are on the lower risk side, but they're also giving you very low returns. Like we said, 0.5% is all you're really going to get if you're going to put your money into the credit union or the bank. In between that, you have intermediate term and long-term debt. So those are your bonds, and you can either have bonds that the US government owns, or you can have bonds that companies will issue. And then as you go out further on the risk reward scale, you can have corporate stock. So the large corporations, like we talked about Ford being a large one that's in the S&P 500, that's going to give you a higher return. And then if you go out and buy smaller companies don't have the resources that the larger companies do and may fail more easily. So you're taking on a little bit higher risk by going into small company stock. And then if you go all the way out, we can look at foreign investments. So there you're investing in stocks of companies that are overseas, and some are in emerging markets. And you could have a very, very high return from those because they're much, much riskier, but there's also a downside to them. So this kind of gives you an idea of how the risk return looks like and why you get larger return for taking on larger risks. But risk does not equal reward. And a great example of this is 1,001 Days in the Life of a Thanksgiving Turkey. So you have a turkey that's born and it's going along and living on the farm and having a great time. And, you know, by day 1,001, surprise, you know, the turkey is chosen and it becomes somebody's dinner. So what I'm trying to show here is that, you know, even though you are getting a higher return for some risky things, there can be surprises out there, and you really have to understand what you're investing in. So how do we get around that? Now, this chart looks very, very busy, but what I want you to look at is the very top row and the years going across the top and the colors. So if you look at 2019, you will see USLC, which stands for US Large Cap Stocks. So those are the stocks that are in the S&P 500. And in 2019, they provided a return of 31.5%. Right underneath it, USSM, which is the small cap stocks, provided a return of 27.8%. And right below that, international returned 21.6%. But I want you to look back 1 year to 2018, and you can see that in 2018, the international stocks were down by 14.8. So the 21.6 that you got in 2019, you had gotten negative 14.8 in 2018. And if you look across the chart, you can see that every year there's a different winner. But look at the 5, 10, and 20-year chart, and you can see that if you stay the course for longer periods of time, then some of these things don't move around as much. So the first thing I want you to look at is the fact that each year a different sector and asset class does well. And there's not one that's on that top row every single year going all the way back to 2004. But if we take a portfolio that is 60% stocks and 40% bonds, you can see that things even out a bit over time, and you are going to have a good return. It may not be the highest return in that year, but it certainly will provide you with a great return. And you can see that in the 5, 10, and 20 years, you're making over 5.5% by being in a portfolio with 60% stocks and 40% bonds. So this is the concept of diversification. When you diversify your assets and don't put everything into one thing, you're never going to invest in just one stock. You're never going to invest in just one type of sector in the market. You will get a very good return. So here are some tips. Never invest in something you don't understand. So again, we're going back to that billionaire Warren Buffett, who is considered the world's greatest investor. He says, if you can't explain it to a 5-year-old and you don't understand it enough to invest in it. So if I can't explain what I'm investing in to a 5-year-old child, run away from it. As a woman, go with your gut. If it sounds too good to be true, it probably is. Third thing, approach investing with a long-term objective. If you're saying you're going to put this money aside for 10 years plus to meet your goals, and it's based on strategy, it's not based on hope or luck, then you're not going to have to react from fear or greed, and it's going to provide a peace of mind. As I said in the last slide, don't put your eggs in one basket. It's always good to have options and to sleep well at night. And another thing, good investing is slow, it's simple, and it's often boring. Now, if you listen to the TV all the time with people hyping stock at you and making it sound like it's so unbelievable, investing is not hype. It shouldn't be complicated and it shouldn't be expensive. There are many, many investment products out there. So it's unnecessary to invest in products that are complex and risky. And you also don't need to decode the economy, follow the stock market, or be a stock genius to invest. If you just get your financial plan in place and apply simple rules over the long term and stay the course, you can be a great investor. So when do you invest? You invest when you have money that you don't need for 5 to 10 years. You invest after you pay off your credit card debt. You invest after you pay off your student loans. That is because those things are carrying such high interest rates. Last time when we spoke, I showed you that credit cards are charging 15 and 16%. In all the charts that I showed you, none of those investments are going to get you 15 and 16% a year. A good diversified portfolio will be getting you about 5 to 8% over the long term. So paying off your credit card debts, you're paying yourself first. And then after you have 6 to 12 months of money set aside in case of emergencies. So it's only, oh, and there's a typo there. Sorry about that. And so if you have the money that you don't need for 5 to 10 years, have paid off credit cards, student loans, and you have your emergency money aside, that is when you start investing. And so in conclusion of the 3 sessions that we had, we talked about debt and not being buried under the debt, paying it off. We talked about how to create a budget and looking at what's coming in, what's going out, how to get that budget lower so that we have some savings. We talked about creating our goals. What are we trying to save for and what do we want to get to? We talked about savings, how to put it into a bank, a credit union, and now how to invest. And that is the final step to creating your financial freedom. So the key takeaways we've learned about in this session: savings, credit, debt, purchasing long ticket items such as cars, homes with loans and mortgages and taxes. We learned about financial planning and investing, but that only scratches the surface. But it gives you information to provide you with financial freedom. So what I want you to take away from this is that this is only the beginning. This is only trying to make you aware of what's out there. And I am happy to answer any questions that come into the Q&A. And the other thing is, if you want more information, There are great books out there. There are great podcasts out there, and there are a ton of online resources. So for further reading, One Up on Wall Street by Peter Lynch, it's been out there for a long, long time. It's a great book that talks about what goes on with Wall Street and investing. Burton Malkiel was a professor. He wrote a book, Random Walk Down Wall Street. Michael Lewis, if you want something that's more novelty, wrote a book about The Big Short, and it really shows the problems you can get into. And then Tom Stanley wrote a book a long, long time ago about The Millionaire Next Door, which was just basically, everyday people who saved their money and had $1 million saved up by the end of their life. There is very helpful podcasts. There's one called The College Investor that it breaks things down very easily. And then there are some online resources, ETF.com University, Investopedia Education, and Investor.gov, and it gives you some introduction to investing. So I recommend that you take a look at all of those resources, and you can get more information, more than I could provide in the short amount of time that we have. So with that, I am going to stop sharing my screen, and I'm going to go back to, if I can, hold on. I'm going to go back to our group and, sorry, stop sharing. There we go. And I am going to invite back Barry Ziegel, who is going to be letting me know if there are any questions that people in the audience had.
Thank you very much, Aviva, for a very informative seminar. We really appreciate it. And I think everybody really learned a lot, which is wonderful. We do have one question in the Q&A that came in from the audience. The person asked, which one was Madoff's case, bond or stock? And how can we make sure something like that would not happen to us?
Okay, so in Madoff's case, it was actually more than just bonds or stocks. The problem there was that Bernie Madoff was acting as the custodian of the funds, meaning that he was the one that was holding the investments for investors. So what Bernie did was he had people give him money. He was supposed to invest in stocks, bonds, or whatever else, and he actually didn't. And he created statements showing people what their position was. Now, at the beginning, he started out investing in stocks, and he may have had bonds and things in there as well. But at the beginning, he was actually investing, and he was providing good returns for his clients. But when things started turning poorly and he wasn't making those great returns, he just started sending out false statements telling people that what he did was not actually what was going on. So the way to get around it is to make sure that you put your money with a custodian who is going to hold your funds and show you a statement every single month about what you actually hold. So for example, our investors at Wealthspire, we use various custodians, Schwab and Fidelity being the biggest, where our clients open an account with those custodians. And they are the ones that hold the money. So I don't actually have access to their money. What I have access to is the ability to trade in their accounts for our clients. So I can tell Fidelity and Schwab, I want to buy the Standard & Poor's 500 index for a particular client, and they will execute the trade, and then it will show up in the client's statement. I don't hold the money. So there's no way for me to do what Bernie Madoff did with his clients, because he was actually the bank as well as the investor at the same time. And that is never a great idea. So the best way to protect yourself, make sure that your money is with a good, well-known custodian, and that your financial advisor is just the one directing the custodian what to do for your account. And you want to be able to have access to your statements all the time. And all of these large custodians like Vanguard and Fidelity and Schwab, et cetera, you have daily access. You can go on at midnight if you can't sleep, and you can see exactly what you own and what's in there. And it's all truthful, unlike what Madoff was sending to his clients.
Great, thank you. Our next question is, what are the best stocks to invest in right now?
The best stocks to invest in right now, I haven't a clue, and I wouldn't want to give you that information because number one, as I said at the beginning, investing is long-term, and number two, you can't time the market. So if I tell you that, oh, Tesla has gone up, an amazing amount, jump into that. That is not going to tell you what it's going to do in the future. The best way to invest in stocks is to have a diversified portfolio of stocks so that no matter what goes up or what goes down, you're participating in the market return. So number one, make sure your time horizon is longer than 5 years. Number two, diversify your investments and don't just buy the best stock that you hear about because last year's winner could be this year's loser. And number three, make sure that you are doing your research, not paying too much to get into something and not just buying last year's winner. If you look at the market over the past 3-4 years, there have been 7 stocks, just 7, that have done the majority of the market return. And all the other stocks, some were down, some were just kind of like moving along, but 7 stocks represented the majority of the return in the market. So my suggestion is go on to Fidelity, Vanguard, Schwab, buy yourself an exchange traded fund, that's an ETF, of the S&P 500, which is the Standard & Poor's largest 500 stocks. ETFs are very, very inexpensive. They contain all 500 stocks in the Standard & Poor's 500, and you will get the market return without having to worry about the best one to pick.
Great, thank you. Next question, which brokerage account is the best one to open?
Okay, so brokerage account. Okay, if you go to a broker, you're actually going to the person you're going to be working with. Okay, all brokerage firms offer similar things. Brokers are going to get paid by the amount of transactions that they do in your account. What I would say is find somebody, and there are a lot of online resources for how to find a financial advisor and how to find a firm. Talk to your friends, find out who they're using, go to somebody who you trust, and make sure that they are doing the things that you need for you and not for themselves.
Great, thank you. Next question, any thoughts on Bitcoin?
Bitcoin. So Bitcoin is one of those things that is not custodied anywhere. It's somewhere in the ether, and there's nothing to tell you what the price is based on. With a stock, you're looking at what the company is actually earning. You're looking at what their future earnings are predicted to be. You know how many customers they have. You can touch and feel what they're selling. Bitcoin is something that I can't touch, I can't feel, it's not custodied anywhere, it's not a legal tender currency in the United States. So personally, I am staying away from it. There are a lot of investors that are jumping into it, but to be a conservative investor where I can tell my clients, I know where your money is, how much it's worth, and what's going to happen going forward, I can't do that with Bitcoin, and therefore I shy away from it.
Thank you. What I believe is the last question, and then we have one other question I'll answer at the end. The question is, what's the best option to invest if I want to avoid interest because of religious reasons?
Avoid interest?
That's the question. I'm not sure that you're able to answer it, but that is the question.
Okay, so if for religious reasons, I'm going to answer this from the point of view of I have clients that do not want to invest in things like they don't believe in ammunition or war or those kinds of things. There are many funds out there that are that will run programs to make sure that they're not investing in any manufacturer of guns, etc. If for religious reasons you don't want anybody that's doing, for example, pork products or non-kosher food or things like that, there are exchange traded funds and mutual funds out there that will avoid those things. You can also talk to your wealth manager and say, I don't want you investing in various things. We have clients that don't want to invest in things where companies that are doing birth control, those types of things. So there are ways to screen for those things that you do not want to invest in. And then on the flip side, we have a lot of millennial clients that want to invest in sustainable things and environmentally friendly, et cetera. And so they won't invest in oil companies, and they won't invest in companies that are producing machinery to do fracking, those kinds of companies. And so you can run a program to remove those from your investments, and that way you can have a portfolio that reflects your values. If that's not what your question was, type it in, send it to Barry or to Leslie, and I'm more than happy to answer it if I missed the mark.
Great. Thank you very much, Aviva. And to the person who asked if there's a way to see the previous sessions, the answer is yes. We have all 3 sessions recorded, and we can send them out to all of the attendees for all of the sessions. Thank you. And now I'm going to turn it back to Ina Kupferberg.
Thank you all for joining us this afternoon. Aviva, this was a wonderful and informative program, and we wish you all a wonderful day. Thank you so much.
Thank you, Ina. Thank you, Barry. And thank you, Leslie.